What's going on, everybody? My name's Jose from deepdatainvesting.com, and today we'll be going over the balance sheet. Quick plug, if you haven't already, sign up at deepdatainvesting.com. It's totally free and you'll receive golden nuggets via email bi-weekly. It's just our way of spreading the knowledge. So exactly what is the balance sheet? Well, the balance sheet is one of three core financial statements that help determine or evaluate a company. One of those being the income statement, and we've already covered that in the previous videos, so I'll link it in the cards above or the description down below. So the balance sheet is made up of three parts. It's made up of the assets, the liabilities, and equity. The assets being any valuable resources that the company owns, like machinery or actual cash. Liabilities are debt or balances on suppliers. And equity is everything that's left over if all the assets were sold and all the liabilities were paid off. So why is the balance sheet so important? Well, you want to make sure that the company that you're about to invest in is made up of value and not just built up on top of liabilities and just pure debt. So like I said, the balance sheet is simply just a snapshot of what the company owes, and the equity during some period of time. So if you're looking at a 10K report, you're looking at an annual period. And if you're looking at 10Q, you're looking at the quarter period. So why is it called a balance sheet? Well, if we take a look at this T graph, you can see that assets are on one side, liabilities and equity are on the other side. And these two columns must always balance. This is why it's called a balance sheet. If we take a look at the basic accounting equation, you can see that assets equals liabilities plus equity. We can move these terms around and we can find the other equivalents. So you can see that equity equals assets minus liability. So you can see why it's called a balance sheet. Everything just balances out. So I feel like the best way to learn is actually going through a practical example and looking at an actual balance sheet. So in the previous video, we went over the income statement of Microsoft. So we'll do the same thing for the balance sheet. That way we follow the same theme. So we're gonna jump in there, go to the SEC Edgar database, go to the recent Microsoft 10K, and analyze the balance sheet. And just like that, we're back in the SEC Edgar database. If you're not familiar with the Edgar database, we made a whole entire video explaining the SEC Edgar database and how to do your due diligence using it. I'll put it up in the cards in the description down below. Now, right now, we're taking a look at Microsoft's latest 10K earnings report in the balance sheets section. So as I mentioned before, the balance sheet is made up of three sections, right? It's the assets, liabilities, and equity. Let's break this down a little further, starting with the assets. So assets is divided into two different sections. It's the current assets and non-current assets. Current meaning that it can be converted to cash within 1 year. These are the most liquid types of assets. So that's like hard cash or treasury bills or other short-term government bonds that with like a short-term maturity date. Non-current assets are assets that cannot be liquidated within 1 year. So that's like long-term stuff like, I don't know, like a warehouse that can't necessarily be sold within 1 year or things of that nature. All right, so let's just go line by line down the balance sheet and then just kind of explain what everything is. So right now we're looking at the current assets. So let's see. It's cash and cash equivalents. Cash and cash equivalents are it's just cash on hand, and it might be also short-term investments that are near their maturity. Next, we have short-term investments. Now, these types of assets are all just marketable securities. That being said, they're just assets that can be liquidated to cash. So these things might be like stocks or treasury bills or bonds, anything that can be sold within 12 months that are easily liquid. Now, if we take a look at the numbers here and we sum the cash and cash equivalents and short-term investments, we get the total cash equivalents and short-term investments. In this case, in 2020, it was $136,527,000,000. That brings us to our next section under current assets. That is accounts receivable, net of allowance for doubtful accounts of $788 billion and $411 billion. Okay, so let's break this down. What's accounts receivable? Well, accounts receivable is the money that's owed by a customer to a company. So that is if the company offers a customer some kind of credit line, they're allowed to buy their product and then later on pay it within some kind of grace period. So that is owed money by the customer to the company. And the net allowance for doubtful accounts is any money that they're probably not going to receive because the customer just went over the grace period and they're not expecting that money to come in during this period of time. So This is the net, and that's what it's taking account to. And for that section, we have 32 billion, 11 million. Next, we have inventories. Now, inventories is just like any other store. You're gonna have goods for sale. So in Microsoft's case, this might be like any of their product lines, like their laptops, like their Surface laptops or Xboxes, and this is all stuff that is for sale, and it's probably in their warehouse or anything that's has not been sold yet. Then we have other current assets of $11,482 million. So what is other current assets? Well, for that item, we'll have to go down to the accompanying notes and just read off the details that Microsoft has provided for us. This is why it's really important to know how to read these reports so that you as the investor can go ahead and go into these financial statements and read in detail exactly how this company is spending their money, where is their money going, how they're making their money, and it's things like that. This is important things that you must do when you're doing your due diligence. Again, check out our SEC Edgar database video so you can learn more about that. We finally reached the total current assets of $181,915 million. That was the current assets. Let's get down to the non-current assets, which again, these are all assets that cannot be liquidated within 12 months. First thing we have here is property and equipment with the net accumulated depreciation. So this is the value of their properties and their equipment combined with the depreciation accounted for. So in this section, we have $44,151 million. All right, so this is property and equipment, right? So it's any kind of real estate that Microsoft owns. So this could be like warehouses or Microsoft stores, any valuable equipment that Microsoft has to take account for. All right, so the next one is a bit weird. It's the operating lease right of use assets. Now, these are operating leases that Microsoft has, but because under ASC 842, it is required to record these on the balance sheets if they meet certain criteria, such as the lease has an option to purchase. Again, whenever you're evaluating these kinds of things, you should read the accompanying notes to better inform yourself on these leases. But as you'll see later on in the balance sheet, you'll see the remaining debt taken account for in the liabilities section. I hope that wasn't too confusing, but if you guys need to, just play it back a few times until you grasp the idea. But the next section, we have equity investments. Now, equity investments is the same thing as any, marketable securities that the company might be invested in, but this is for a longer term and it's planned to be held for a longer period of time. Next is Goodwill. Now, Goodwill is a little hard to explain without explaining what intangible assets are first. These are assets that are not physically there. They're not, like a piece of equipment or anything like that, but it's more things like the company's brand recognition, good customer base, good employee base, intellectual property like copyrights and trademarks and patents, any kind of proprietary technology that the company has. That is what an intangible asset is. Now, the goodwill is actually when a company acquires another company. The goodwill is actually the purchase price minus the book value. That is the purchase price minus the fair market value minus the fair market liabilities. So in essence, the goodwill is the other company's intangible assets value. So I'll give you a quick example. Let's say Microsoft purchases a company for $1 billion, but its book value is actually valued around $900 million. Well, then the goodwill is $100 million because that's what's left over. And I'm just oversimplifying it there, but that's just an example for you. So we got goodwill out of the way. We got intangible assets out of the way. Now we have other long-term assets. And this is something else that you'll have to check out the accompanying notes just to clarify on what exactly those long-term assets are. With that said, we finally get to the total assets with $301,311 million worth of assets for Microsoft. That's incredible. If we take a look at previous periods for the balance sheet, we have $286,556 million for the previous period. And now in this period, we have $301,311 million. So that the company has already increased the value of their assets. That's a good sign. All right, so we're finally done with assets. Now let's get to liabilities. And this is really simple. I mean, it's just money that Microsoft owes to either banks or suppliers or the government, like for taxes and things like that. So let's not get too complicated and let's get straight to it. So just like assets, this is divided by two parts, particularly in time periods. So we have current liabilities and non-current liabilities, which current liabilities are any liabilities that are owed during 12 months. And non-current liabilities are long-term liabilities that are due over 12 months. So first in line, we have accounts payable. Now, accounts payable is any kind of money or debt that is owed to suppliers or any vendors that offer the business goods or services. Next, we have current portion of long-term debt. Now, this is the portion of the debt that Microsoft will be paying for that period for their long-term debt. So like, let's say they owe $1 billion in long-term debt. Well, in that year, they're going to pay, let's say just 25% of that. They're going to pay $250 million. And that's what the current portion of long-term debt is. Now, in this case, they're paying $3 billion, $749 million of that debt. Okay, so now we have accrued compensation. Accrued compensation includes any kind of salaries or benefits or vacation, anything that's paid off to employees. Short-term income taxes are taxes that are due during this period of time or before those 12 months. Next, we have short-term unearned revenue. Now, this is quite the opposite of accounts receivable, where the customer has already prepaid for the product but has not received it from the company yet. Then we have other current liabilities, and that's something else that you'll have to go into detail with the accompanying notes. We finally get to the line where you get the total of the current liabilities. Up next, we have the non-current liabilities. Now, first we have long-term debt. Now, according to the SEC Edgar database labels, long-term debt is, but not limited to, notes payable, bonds payable, debentures, mortgage loans, and commercial papers. Now, this excludes capital lease obligations. So that's what long-term debt is. Then we have long-term income taxes, which of course are just taxes that aren't owed for the next 12 months. We have long-term unearned revenue, which is the same thing as the short-term unearned revenue, but this might be for just like pre-sales of a future product that Microsoft might be selling that they already received money for, but they haven't transferred any goods or services to those customers. Then we have deferred income taxes. Now, again, according to the Edgar database documentations, this is the amount after deferred tax assets of deferred tax liability attributable to taxable differences with jurisdictional netting. Simply put, it's just deferred taxes because there's some kind of difference between the IRS tax rules and the general accepted accounting principles. Operating lease liabilities. Now, these are the operating lease liabilities that I mentioned before in the asset sections where we were covering operating lease right of use assets. So this is what I mean when I said it would balance each other out here. So this is just the payment for the operating lease pretty much. Then we get other long-term liabilities, which is just the amount of liabilities that are due after 1 year. Then we get to total liabilities, which is the summation of the current liabilities and the non-current liabilities. Now, in this section, you can see from previous years or previous periods, you can see in the previous period, it was 184 billion. Then it went down to 183 billion. So you can see that the liabilities are actually decreasing and the assets are increasing, which is a really good sign. Then we finally get to the last piece of the puzzle. Equity. This section is made up of the common stocks and the retained earnings, but let's go over it one by one. So we have common stocks and paid in capital. So this is pretty much how much common stock is issued out and how much is owed by the company. And so here we have shares authorized, which is 24 billion shares, and there's an outstanding number of 7,571 and 7,643. So in this section we have it's worth $80 billion, $552 million in this period. Now, if we take a look at this number in previous periods, you can see that there's an increase, which is a good sign. Okay, so next we have retained earnings. Retained earnings is simply just the undistributed earnings in forms of either dividends or just reinvestment. So we have 34,566,000,000 in this section. Then we have accumulated other compensation and income. Now this one's a little tough to understand, but from what I understand, and this again, I'm taking it from the Investopedia website, but it's the unrealized gain or loss accrued from an investment or pension plan or hedging transaction that has appreciated or depreciated in fair value. Again, this is from Investopedia. And if we take a look at this number, it's actually positive $3,186,000,000, where in the previous period, we actually had a negative $340 million. So another good sign here. So now we have the total stockholders' equity of $118,304,000,000. And like I mentioned before, the assets is just the liabilities plus the stockholders' equity. So right here in this bottom line, we have $301,311,000,000. And if we go up here with the total assets, we have the same number, $301,311,000,000. So therefore, this balance sheet is balanced. And that's it, folks. This is what a balance sheet is. To make it simple, it's just what a company owes, what a company owns, and their equity. All right, so that's it for this one. I really hope that the animations and the graphics are really helping you out. Just let me know if it's working out for you guys in the comments down below. If you haven't already, please subscribe. We're gonna be dropping different videos on financial education and investing so that we can help everybody out here. Also, don't forget to go to deepdatainvesting.com and sign up there. All right, guys, well, thank you guys for watching. We'll see you guys next time.